Hello, chart watchers, and welcome to this Wednesday, March 14th Market Watchers live show with your hosts, Tom Bowley and Erin Swinland. For those of you joining us for the first time today, welcome to the show. We're certainly glad to have you. And for our regulars, welcome back. Well, we're seeing a little bit of negative action today in the market. You can see the Dow Jones right now down nearly 300 points, leading the way for sure. S&P 500 down 15 points. So while the Dow Jones is down more than 1%, you can see that the S&P 500 actually down just a little bit more than 0.5%. The NASDAQ down even less on a percentage basis, down 28 points, but it is near the low of the day. And the Russell 2000 down about 0.5%, down 7 points today after challenging its all-time high yesterday in early action. The 10-year Treasury yield, this is interesting. We've been talking about this range from the 280 to 295 level, and we are now back down at the bottom of it. Part of it is on the heels of a less than stellar retail sales report that came out this morning. We'll talk about that in just a couple of minutes. Volatility back on the rise a little, back over 17. Worth noting, at least, it's up 4% today as a little bit more fear creeps into the market. Utilities, the top performing sector today, up about 0.7%, something like that. But it is up over $50, as you can see, clearing the recent price highs that we've seen, but struggling to get through the late February high. EIX, Edison International, one of the strongest stocks. Actually, when I looked, it was the strongest stock in the S&P 500 today, and this is in the utility space. Ford got an upgrade today. We'll talk a little bit more about that later, but Ford up, you can see, about 3%, another one of the strongest performers in the S&P 500. The industrials struggling again for the third straight day, and part of the reason has been the aerospace stocks. You can see aerospace the last 3 days getting hit hard, very hard today, as Boeing takes a big drop, down $15 today on the heels of its drop the past 2 days, and it is now challenging what I consider to be pretty significant short-term price support just below the 320 level. And with that, let me bring in my co-host, Erin. How are you doing this Wednesday morning, Erin?
I'm doing quite well. And funny you bring up the Boeing chart. I know somebody had requested that and had wanted to know if you'd buy that pullback. So might go ahead and put that up in 10 and 10.
Yeah, I mean, every group, every stock is entitled to have a period where it doesn't perform well. Boeing has been going down on a lot of volume, so I think it's worth watching. But I believe in watching these price support levels. What I'd actually feel better about is if it were to take out that prior low. I'm going to bring up the Boeing chart later, and we'll talk about this in the technical news segment. But I like Boeing. I think that this is presenting an opportunity, but I think you want to be careful about jumping in too quickly, or maybe just getting in over, maybe in increments. I'd feel better if it puts in some sort of reversing candle or has a false breakdown. But again, we'll talk about that in a bit. We do have a special guest today. We've got Greg Morris with us. Greg, how are you doing today? Hey there, how you doing?
I'm doing great, thanks.
That's awesome. It's always good to have you on the show. I know you're taking a little bit of a break from the golf course to be with us today.
Yeah, it's a little cold down here in Georgia.
You know what? We didn't even talk about this yet. I got up this morning. Well, I went to Starbucks, did my regular routine with my blog, and got the blog all posted. And I was leaving just after, well, actually, it was just before 9 a.m. And I'm south of Charlotte, about 20, 30 minutes, just into South Carolina. And it was snowing this morning.
Oh my God.
Yeah. That was the exact same response I had when I saw it.
Yeah, I don't play golf and stuff like that.
Exactly. I mean, we've already sprung forward. We're in mid-March. I'm in South Carolina, not even North Carolina. It's got South, right at the beginning of the name, South.
Yes, yes.
And yet Mother Nature trying to punish me yet one more time.
Everybody wants to punish you, I think.
I'm just constantly being punished.
The market. Well, yes, actually, we have a poll going. I'm going to be doing my workshop on Friday. And go ahead and put your favorite topic. Just go ahead and vote. There's a polls tab right there in the Slido app. And go ahead. Let me know what you want me to do it on, and we'll see what it looks like at the end of the day. But yeah, I'm going to run it until, I think we're going to run it until the end of the day. today or into the morning tomorrow. So you can still go in. If you guys are watching the recording out there, you can see the Slido poll to your right of the viewer screen if you're under the webinars tab, and go ahead and put your vote in.
Yeah, I would say too that with 20% of the precincts reporting, we got a pretty tight race there with that poll.
Yes, exactly.
It was very tight, way too close to call. So
yes.
keep voting.
Keep them coming. All right, weekly schedule. What's going on for the rest of the week? Well, I know tomorrow we have our favorite guy in town on our blog Rolls, Julius de Kempenaar, the RRG creator, will be with us. And then Friday, like I said, I'll be doing my workshop, and go ahead and vote under polls on the Slido app and add your thoughts as to what you'd like me to do. For today, however, we're going to have Greg Morris step up to the plate at 12:20, followed by the 10 and 10 to 1. And our first symbol is going to be PayPal Holdings, PYPL. I think it's one of the most active today. And we can also see we'll have a scooter report at the end. Tom and I will give you our viewpoint as to what's going on with our scooters. And with that, I'm going to pass it back to you, Tom, for the technical news.
All right. Interesting day today in the bond market. You know, usually, well, probably for the past month, we always start with the TNX, which is the 10-year Treasury yield. And it's been kind of boring and almost, you know, this is really what I've been anticipating, was just a sideways action, because you can see the PPO on the 10-year Treasury yield had rolled over as we were putting in new highs. And that just tells me we probably got a little ahead of ourselves, needed a little bit of a pullback, consolidation, maybe even a 50-period test. And it's going to be very interesting today to see whether or not we close below 280. We are at 2.804 right now on the yield, testing this early March low. And so this sideways consolidation that we have been mired in for about 5 weeks, we could see a break to the downside. But I think if it does, probably going to see maybe about the 274, 275 level. And that's about as low as I would expect that we will see the 10-year Treasury yield go. But if that does continue to the downside, it can have some pretty serious short-term implications in areas like financials that tend to do well when the TNX is rising, and tends to underperform when this is moving lower. So if you're in financials and the 10-year Treasury yield doesn't hold 280, you're probably going to see some deterioration in your portfolio. Just be aware of that. I don't think, again, that this is a long-term top in the 10-year Treasury yield, that we're going to be moving lower for much longer, but we do want to watch that 50-day moving average. A couple of interesting charts. Of course, every chart is an interesting chart for us, but let's pull up the NASDAQ, because the NASDAQ, it's not down as much as the Dow and the S&P 500, but it is now testing the top of gap support. And the prior high back in January was just above 75. I think that was either 75.06 or 75.05. Yeah, closed at 75.0577. So when you get a breakout, I'm always looking for a pullback to test that breakout level. So the question for me right now is, do we close below that 75.06 area, or is it just an intraday move and then a finish back above? And that's going to be really important, I think, in the short term for the NASDAQ. I had written in my blog earlier today, and I'm going to pull up this chart on the 60-minute chart on the NASDAQ, because I was looking at the negative divergence. First, I'm going to pull up the live version here. But if you notice, with the higher prices that we saw earlier this week on the NASDAQ, the 60-minute PPO had rolled over. And so just like a daily chart or a weekly chart, when I get a negative divergence on an intraday chart, I do look for short-term, very short-term weakness. Now, it could develop into longer-term weakness, but given the strength of the PPO on the daily chart, I don't think we're going to see a whole lot of weakness here on the NASDAQ. But the first thing I would look for after a negative divergence prints is to get this center line test and to get a potential 50 period, or in this case, 50-hour SMA test. And we are just about there on both currently. And if you look back, we had a similar type situation develop in the third week of February when prices went higher on the NASDAQ. We had been holding the 20-hour EMA, but as soon as that negative divergence went in, lower PPO, higher prices, we went all the way back down, nearly touched that center line on the PPO, and also nearly touched that 50-hour SMA before we resumed our uptrend. So I think we've got some key price support that comes in here, as well as gap support as we move down on an intraday basis. Now, if we fail to hold the bottom of gap support, which is at about 74.30, then I think we could be opening ourselves up for a little bit more weakness to the downside. If I pull up the daily chart, though, that rising 20-day moving average is at 73.61. So if I scroll back one more time, that would be down in this area. So if we fail to hold the gap support, then I would say we might have another 1% downside on the NASDAQ before we hit that daily, that key 20-day moving average on the daily chart. I'm going to go into the sector summary for a second, because this is an area that I start with every day. I don't talk about this every day, but almost every day, 10 minutes after the market opens, 15 minutes, I'm usually into the sector summary to see where the money is rotating toward. You can see the only group leading today, or the only group in positive territory today, is the utilities space. All the other 8 sectors are lower. Industrials really taking it on the chin. And if we click on the industrials, we will see that aerospace, talked about this in the opening, aerospace really taking it on the chin. If we click on that and we reverse there, you can see that Boeing down 4.77% right now, clearly leading to the downside, but there are others as well. Spirit Aerosystems, SPR, down 5%, and I think it was United Technologies, only down 1%. But you can see there's a lot of weakness in this particular space, not just today, but really over the last 3 days, with Boeing leading the action to the downside. I'm going to get back into Boeing in just a couple minutes, but first, I wanted to go back here. And, we're almost 3 months into the year. We've had a lot of volatility back and forth. So I thought it would be helpful maybe to look at a 3-month sector analysis. So here is how things stack up over the last 3 months. Sometimes I'll look at how the relative performance is by looking at, say, the XLK versus the S&P 500. But this is a makeup of all the sectors. And you can see over the last 3 months, technology's been the best performing group at 9%, rising 9%. Consumer discretionary is up 8%. Then you've got financials, healthcare, industrials. Industrials, financials, consumer discretionary, and technology are the 4 aggressive groups. And so over the last 3 months, we are seeing mostly strength in the aggressive areas of the market. That normally doesn't align with a market that's topping because traders are willing to take on the additional risk. So they've got a much higher risk appetite, and that is more prominently aligned with bull markets than with bear markets. So, and it's just one piece of the puzzle, but for me, it's enough to suggest that the bull market has not ended, that we're continuing to move higher, that these NASDAQ recent highs should be respected, and so forth. Now, I want to go into just a couple of individual charts within these groups. Technology, for instance, is leading, and one of the areas that has been very strong is the semiconductor space. You can see a huge move up, nice recovery, reversing candle right off the 20-day moving average as it moves higher with the PPO accelerating. I think that's a great sign. The breakout, though, is at 35.50, and you can see that the rising 20-day moving average comes up at 35.18. So as we drop further and further on the semis, if we continue to drop, I think the reward to risk in the space starts to look pretty interesting. When we get into scooter reports later, I'm going to be looking at some of the semiconductor stocks, especially some of the small caps, to see if there are some potential trades in that area. Moving on to the consumer discretionary space, one of the groups that's been leading, broadline retailers. And we've talked about this many times, but this is a group that houses Amazon. Of course, Amazon's been awesome, but it did have a double top, had a little bit of a cup, handle back to the 20-day moving average and breakout. This actually measures from 1650 down to 14 and a quarter, which is 225 points. Added on to 1650, and that's 1875 measurement on broadline retail. So not only has this group been leading, but I would expect that we're going to continue to see leadership here. Let's take a look at one other area, which is in the financial space. I want to bring up the DJUSSP, which is your specialty finance group. Another group that we do have a negative divergence. So I'm going to be watching closely to see if price support holds at 230 along with this rising 20-day moving average. But the negative divergence is the higher prices here with the slightly lower PPO. Now, if we hold around 230, break back out to the to new highs, and we can get this PPO starting to rise again, would be okay. But I mentioned earlier the fact that financials could struggle if we lose 280 support on the 10-year Treasury yield. If that happens, this is a group that I think is really vulnerable in the near term, back perhaps to this recent low around 220, 223, and you can see the rising 50-day moving average. That's what I would look for with a negative divergence anyway. But I do think this is an area where we could see as much as another 4% pullback in this group, while the negative divergence on the 10-year Treasury yield potentially plays out again if we go below the 280 level. I did want to mention, though, let's take a look at Boeing, because I know there were questions about Boeing. I don't blame you. This has been one of the strongest stocks. The thing that bothers me, there's really only one thing that bothers me here, and that's the volume. Today's volume is huge. That can be a positive, though, because if we go back down below the recent lows here, intraday, say get down to 310, put in a lower low, come back up and close above this 318, 319 area, I think we could print a bottom on Boeing. So I'm going to be watching it closely. It's on my strong earnings chart list. I think Boeing is one of the best companies out there. And let's not forget that when we look at a relative chart on Boeing, this thing has been straight up. We've got to give it a little bit of time to consolidate. So I'm okay with the break below the 50-day moving average, so long as this price support isn't broken to the downside. If it is, you're probably looking at maybe 294, 296 in here at these highs as the next key level of support. But here's the aerospace group moving up, sideways consolidation after a big move. Boeing has been outperforming until recently. It has been outperforming the group, and the group as a whole down here, you can see, had wildly outperformed the S&P 500 till just recently. But again, I think this is a pullback that's probably setting up a nice entry opportunity into the stock. And with that, I'm going to turn it over to Erin. She's got a couple of upgrades and I think a downgrade for you.
I do indeed. Let's go ahead and get that screen up for you. Okay, I need to fix that. All right, here we go. We have one downgrade we're going to look at today and two upgrades, so it shouldn't take us too long. I'm going to start with the downgrade. When I looked at this chart, I realized that even before today's serious decline, we had plenty of warning that this one was not going to do what we wanted it to do. So you had a PMO that was completely overbought. It had already started to turn over as this rounded top started to form. And at this point, I think you're looking at least a drop to 235 back here from the July top. So it matches up pretty well with some of these other lows and tops. And I always like to draw those lines with as many touches as possible. So you can see at this point, we've got, it's not looking too good. We do have a decent scooter here, and volume hasn't been horrible, although we can see over the selling period, the last 3-4 days, not good. So I don't see this one as a possibility for as a pickup. So, all right, let's go ahead and look at our upgrade. This one I thought was really interesting. CRH looks pretty good. And the reason I say that is I see this very nice double bottom, this confirmation line on the double bottom. We've now just penetrated that line. Granted, we're not up above it currently as far as price is concerned, but this is really encouraging. The size of this pattern would tell me to expect a price rise that could go all the way up in this $37 range where we were seeing previous tops. So I thought that one looked really interesting. And of course, we've got that PMO buy signal as well. This one probably would have shown up on my scan back here during the beginning of this run. So really good to look at those PMO bottoms even before we get those crossovers, which is why I run the scan that way. Another double bottom set up here and a clear breakout above the confirmation line. And again, I've got this area of overhead resistance, and you can see no problem right now for Ford Motor Company. It looks like we might actually be setting up to get a 50 to 100-day EMA crossover. We start seeing these two converge. We can get out of this bear market configuration. But that 520-day EMA positive crossover, that's a short-term trend model buy signal. If finally, that's pretty much it. Those were the three I had. So at this point, Tom, I'm going to turn it back to you. I think we're going to bring on Greg. Now you can wake up and join.
Okay.
Yeah, we do want to bring in Greg Morris. It's always great to have you on the show, Greg. I know, I read your article from March 12th. And for those of you who aren't familiar, Greg does have an article or has a blog here at Stock Charts, Dancing with the Trend. And really, I thought it was a really nice rules-based trend-following model that you talked about on Monday. I don't know what you have to talk about today and what you're going to go over, but I did want to just point out that I thought this article was great for those of our listeners out there that like to catch up. Just go in and look for Dancing with the Trend under the blogs, and I would catch up with Greg's latest article. Great article.
Thanks, Tom.
You're very welcome. So what do you got for us today? I mean, we haven't talked to you in a while, and there's a lot that's been happening in the market. I mean, we've seen a big scare, huge move down. There's been a lot of discussion here on the show over the past several weeks with many guests, whether, this is the start of a bear market, whether it's just a correction before we make another push to the upside. There's a ton of discussion about the dollar. The dollar's been under a lot of pressure since December of 2016. Is that bottoming, or is it ready to head lower? I mean, do you have any thoughts about any of what's been going on here, or do you kind of just try to ignore the noise and just stay with your longer term?
I just stay with my model. In fact, when I started writing about a rules-based trend-following model, the number of subscribers went through the roof. I've talked about it off and on for a couple, 3 years on the blog. When people ask me what the market's going to do, I say I have absolutely no idea, and I honestly don't think anyone else knows either. And I try not to offend everybody, but just a few at a time.
All right, you just
and the beauty of following the model is the model will adjust to whatever the market's doing, and I don't have to know what the market's going to do because I just follow a rules-based model. That's the beauty of the whole thing.
Yeah, I always like to think I can predict what's going to happen, and sometimes I'm right, and then of course what the other side of it is.
Oh yeah. I used to like on the cartoon net. I'm sorry, CNBC. I used to see all the talking heads come on there and make their predictions, and I thought there's no consequence for them to make a bad prediction because they still get invited back on. And there's one guy that's just on. I don't think he's ever right. He's just on the wrong side of the market every time, but he's still being invited back. He must be a good advertiser.
Yeah, I always wonder about that. I know back in, and I hate bringing up names because these are probably great people and all, but
sure.
I know back in 2006, 2007, right before the financial crisis, and of course, it's hard to predict that kind of a move to the downside. But I remember Dick Bove coming on to CNBC and talking about financial stocks just day in and day out, and how they kept getting cheaper and cheaper, and how they were a great buy. And this was right before the financial system, essentially almost collapsed.
Sure.
And, many of the stocks took years and years and years to recover. And that's exactly what I thought about at the time, what you were just talking about, because they kept inviting him back to talk about financials. I'm like, really? Is this the expert that you want?
The poor souls that follow fundamental analysis, when prices go down, they can go down daily, but the earnings are only reported quarterly. So the fundamentals get really good as the prices go down because they're all related to price in the numerator.
Exactly.
And it just, bear markets just destroy that. So, but today I kind of want to talk about a couple of philosophical things that I've been working on some blog articles, and I'm trying to include these in one of them in the future. But one of them is I call knowledge versus wisdom, and then I try to tie that to technical analysis. Stock charts is kind of like Microsoft Excel. It's just got an abundance of tools and indicators and capabilities. And I use maybe 10% of Microsoft Excel, and I probably use 10% of stock charts. I don't use all the tools that are on stock charts. It takes a lot of knowledge to understand technical indicators. And people should understand what's behind, for instance, stochastics. If someone is using stochastics and they can't explain what it is and why they're using it, that's kind of dangerous.
Yeah.
So I think that knowledge, as far as technical analysis goes, is how to use indicators effectively. and you follow all the blog authors on stock charts, world-renowned technical analysts, they don't use all the indicators. Most of them use the same thing over and over again because they've found the indicator that works best for them, or indicators that works best for them. So the knowledge part is which indicators to use effectively. The wisdom comes in is which of those indicators to use in your analysis, especially if you're trying to make money doing it. I'm on record as saying the indicators that require extreme subjectivity, I avoid them. I see some people that can use them, and they seem to use them very well. But Fibonacci, Gann, Elliott wave, and just for Erin, I'll say angled trend lines. I have never been able to use those effectively. And so the knowledge part is that I don't use them. I have the knowledge not to use them. So it kind of reminds me of something my friend John Ehlers told me a long time ago. He said, knowledge is knowing the tomato is a fruit. Wisdom is not putting one in a fruit salad. Isn't that great? Yeah.
I like that one. I'm going to borrow it.
Yeah, steal it. I did. And then the other thing is I've heard people say technical analysis is science. My God, whoever says that doesn't know what science is. It's an art. Real quick, I'll explain what science is. Science is something that you can do repetitively and reach the same conclusions. For example, I know that at sea level on a standard day, 59 degrees Fahrenheit, 15 degrees centigrade, pure H2O water will boil at 100 degrees centigrade and 212 degrees Fahrenheit. That's science, because every time you do that, it will boil at that temperature. And of course, as you go up in altitude and there's less pressure and the electrons don't escape as much, it'll boil at a lower temperature. That's science. Technical analysis is not science. If science would mean that if stochastics got to 98.6 and then tick down, it means the market's going to go down. We know that doesn't work that way.
So is it science, Greg? If if one of my trades is down 10%, my blood starts to boil?
That's called bad science. That's a good analogy there. So technical analysis is an art, and I get pretty critical of some things that I see out there, but that's just my personal opinion, because it is an art. Everybody finds their own tools and their own techniques, and whether they're just educators or they're practitioners, it doesn't matter. Everybody gravitates to what works for them. You guys do a great job with what you do.
Well, thank you.
So I wanted to talk a little bit about breadth. About 15 years ago, I wrote a book called, I forgot the name, The Complete Guide to Market Breadth Indicators. An entire book on the subject. And the reason I did was twofold. One is I've been using breadth for many, many decades. And all the big technical analysis book authors, Kirkpatrick, Pring, Murphy, they only treated breadth in maybe a chapter. And I thought it was worthy of an entire book. So I did that. And then a couple years ago, we put the entire book on Amazon. This sounds like a sales pitch. And we chip through the programmers there at Stock Charts. We put all of the breadth indicators on stock charts. And so they're all there now, and they all begin with an exclamation point BI. But here's the value of breadth. Breadth is like an equal weighted measure. And there's a chart that I like to show that shows the NASDAQ composite. There you go, on the top. This is the year 2007. Now, most people, when they're talking about the market, certainly the talking heads will use price capitalization weighted indices. The NASDAQ is one. The S&P is one. The Dow is a price weighted, but it works the same way, which means that the largest stocks in that index carry most of the weight. They cause the index to move. For example, on the NASDAQ 100, the top 10 stocks account for 47% of the movement. Breadth, on the other hand, treats every stock equally. ExxonMobil could be up $10 one day, and Bubba's Pizza, the smallest capitalized stock on the NASDAQ, could be down a penny, and they just canceled each other out. One was an advance and one was a decline. What happens is, as the markets start rolling over in these periods of distribution, like market tops, you don't really know it at first, but when the market has stopped going up and it starts going sideways, like we're seeing now, and I'm not making a prediction, but the market hasn't done much this year, especially following 2017, people will tend to loosen up on what we consider their riskier holdings, which are generally small caps, micro caps, and maybe some mid caps. And they will go into what they perceive to be safer stocks, feeling that the blue chips, the large caps, are safer. That's a very common trait, certainly in institutional investors. And because they'll like to talk about it. Well, what happens when they do that? That causes these capitalization weighted indices to continue up moves. When in fact breadth, as you can see there in 2007, that's the NASDAQ advanced decline line, is in a big decline early in 2007, long before the top in the market. You can see that signature almost every time we have a market top. Breadth will deteriorate much quicker and much earlier than price and cap weighted indices will. That's the beauty of market breadth, is that early warning indication. And I've 98 and 99 was a perfect example. Breadth, Russell 2000, which is another kind of a proxy for breadth if you don't have breadth data, it deteriorated for 2 years before the Dow and the S&P followed suit starting in the beginning of 2000. And you can go back over history and you can see this breadth signature at almost every top. The bad news is it's kind of like some economic indicators that call 20 out of the last 12 recessions. In other words, it will happen and it doesn't mean it's a top. You'll see breadth deteriorate. It's for other reasons, but it almost always does it at the actual tops. So that's kind of what I wanted to point out, that breadth is a very important tool to keep in your toolbox for a technical analyst.
Quick question for you.
Sure.
Somebody asked, why is the advanced decline line equal to such an enormous number, like 30,000?
Because it's cumulative. You take every day, you take the advances minus the declines, and then you add that as you go along. The number that makes up the advanced decline line is meaningless. Absolutely, totally meaningless, because it all depends on where you started the calculation.
Mm-hmm.
If you started back when 1971, when the NASDAQ began, it's going to be a totally different number than if you started it somewhere in the 80s. So the number on a cumulative measure like that is a meaningless number. You're just looking at the shape of the line, usually comparing it to the price or cap-weighted index.
All right.
The other thing I want to talk about is an old friend of mine has passed away, Richard Arms, Dick Arms.
Oh.
Dick was 83. He was the guy that created the ARMS index. And in the early days, it was called the Traders Index, or TRIN. And I think everybody's heard of TRIN. It used to be on all the quote machines. This was back in the 70s. TRIN, and I'd have Dick in Dallas all the time to do seminars with me. Great guy. His first wife required a lot of care there in the early 2000s. He's kind of off the radar for a while, but apparently he was having some heart issues, and he was 83. He lived in Albuquerque. A great guy. He's also the one that created, I don't think he created it, but he wrote books on equivolume, where the width of the bar is representative of the volume for the day. So you could see it all in one chart. Stock Charts has all of those on there. Very recently, he did an expose that's published on Stock Charts, I think, on not just candle volume, but candlestick volume, where he shows the width of the candle is also the volume. He used to tell me that he was wrapped up in volume, and this is back when volume was very meaningful because there weren't dark pools and all these other strange places to make trades. He used to tell me when he'd go to lunch, he'd tell his secretary he'd be back in 200,000 trades. Instead of using time, he used volume.
Mm-hmm.
Great guy. Technical analysis lost a good one there. So
yes. We actually do have the trend on stock charts in our
sure.
point market indicator chart back. So
yeah, and it's kind of, Dick said if he was doing it all over again, he would have inverted it, because it's kind of an inverse indicator. When it's up, it's bad. When it's down, it's good. I think it's advances divided by declining volume in the numerator, and then declines divided by up volume in the denominator. That's the formula for it. And he did a version called Open Arms, which I think is kind of encompassing and grabbing. That was supposed to be funny. Where he smoothed the components before he did the calculation. But they're very interesting measures, and like I said, they're all on stock charts, every one of them.
Yeah, I just happened to pull one up for everybody.
Okay.
So, you can see that, and it is a pretty handy one. I know we do invert it, that scale.
Yes, there you go.
I think Carl said that the trick is if it goes over 2. The next day, I guess, is supposed to be an up day, something to that effect. Of course, we know nothing is perfect, but
yeah, it's one of those measures that you look at when it's at extremes usually.
Mm-hmm.
So,
there we go.
The other thing, and this is nothing to do with technical, today is Pi Day, so I guess it's a time to be irrational.
Oh, there you go. 3:14.
Oh, that's so bad.
I should have known that as a math major. I should have.
Yeah, Pi. I tell people my pin that I use on the websites are the last 4 digits of pi. Pi is one of those numbers that doesn't end.
Exactly.
That's so bad.
Math. Now, what are you going to do?
Let's see. I see I've got a few more minutes. There's just a couple other little things I see. I'm very critical of modern finance, and especially the financial media. They put out such bad information so often, and I'm not talking about stock. I'm talking about the news, financial news shows. Mm-hmm. You'll hear them say cash on the sidelines a lot. Well, this market should go on up because there's a lot of cash on the sidelines. Well, that's a complete misunderstanding of the secondary marketplace. There's no cash on the sidelines. When you buy a stock, somebody has to sell it to you. It's just that simple. Mm-hmm. Or when you sell a stock, there has to be a buyer. You can't go buy stock off a shelf somewhere. That's the primary marketplace during IPOs, et cetera. So there's no such thing as cash on the sidelines. A company or a huge investor may have cash on the sidelines, and if they said it that way, that might be meaningful. But to just say it generically, there's no such thing. The other thing, and I think everybody's heard them say that it's a big down day today because there's more sellers than buyers.
Yeah.
Well, that goes along with the same thing I was just saying. There's the same number of sellers and buyers because you can't sell something unless somebody buys it from you. What they probably should say, there's more selling enthusiasm than buying enthusiasm. Mm-hmm. And that would be more meaningful. So anyway, I always like to talk about those because I still hear them on the major financial television stations all the time. It's very sad. Mm-hmm. Pay it, and as advice to people, you want to learn something about technical analysis, stay at stockcharts.com. Chart School is the best book out there on technical analysis, and it's absolutely free.
Right here.
Yeah, it's dynamite.
Yeah. Well, and we also have a lot of folks who, Arthur Hill comes on the show, and of course he's the author of a lot of those articles on Chart.
Oh, yes.
And it's great having the educational side of stock charts coming onto our show to explain a number of the different indicators and some of the common indicators that people use and so forth. Because, again, I go back to your comment that you said earlier, Greg. I completely agree with you. I think that if you're using an indicator and you're buying a stock, you're going to put out thousands of dollars to buy a stock because a line is pointing in a certain direction. I would maybe rethink that strategy. I think you better understand what that line means, number one, and maybe, go back test it, look to see what it's actually telling you. And then maybe use that in corroboration with other technical signals and so forth. I think just pinning your hopes on a stock because one line is doing something, I think is a huge mistake.
Well, the good news is they probably don't do that very long. The other thing is I get asked, what moving averages do you use? Well, I've got my own little rules. I use arithmetic smoothing up to 64 days, and from 65 on up, I use exponential. It's just that simple. But because that's what works for me. In other words, when I see a moving average on something, I don't want to have to sit there and say, well, which moving average should I use? I want to use the same one every time. And the advantage of exponential on longer term is when the price goes through it, the moving average reverses right there. Where an arithmetic moving average, it takes a long time to roll over, especially if you're using big, like 200-day moving averages. Mm-hmm. That's just because of the mathematics of the moving average. The exponential is going to reverse immediately when price goes through it. So
now, would you say that you are much more of a longer term trader or investor?
Oh yeah. I tell the story back in the 80s. I lost so much money trying to be a trader. I just realized I couldn't do it. I mean, I've bought a lot. I have master's degrees in what not to do based on the cost of tuition, but I just didn't have the mentality or the personality to be a trader. I don't know why. I'm glad I realized it at some point. But I am strictly a model follower now. I've been doing this for models for 25 years. It's a rules-based trend following model, and the model's still used by companies today that use it. Mm-hmm. Yep. And so I started this series. In fact, I see it on the screen there. I'm not real good at coming up with fancy names for my articles, so this is number 6 in that series. And here I've gotten into some price-based indicators. I started out with you go back and read them in order, and I'm just kind of building as it goes along. And there's probably going to be maybe 40 or 50 articles total before I get all finished with it.
Wow.
The model has managed over $6 billion.
Wow.
Yeah.
Now, is that going to be in book form at some point, or you just?
Well, in my book, Investing with the Trend, which is my latest and last book, I say that emphatically. I'm not writing anymore, but that's I cover. That book is in 3 almost independent sections. One is it's a very detailed critique of modern finance. Another is all about risk and drawdowns. And then the last chapter, I talk about a rules-based trend following model. Obviously, I can't give the excruciating details of it because it's still a functional model today. Mm-hmm. But in my blog, I'm able to explain it a little bit better.
Yeah, I think probably that's the one, you just touched on the word risk. And I think that's probably one thing that a lot of unsuccessful traders and investors don't pay enough attention to when they're either trading short term or investing for the long term. Everyone gets in with the anticipation that whatever they buy is going to go higher.
Yes.
And I think a lot of folks don't realize, they certainly realize it, but they don't plan for what they're going to do in the event that prices go against them. And I always say, you have to have your target in mind. And I don't care whether you're trading, for today, this week, or whether you're looking out 10 or 15 years. I mean, there's got to be a goal in mind when you get into something. And there also needs to be an exit strategy in the event that things just turn on you. I mean, we saw back in 2000, all the .com stocks that absolutely fell apart. And then we saw in 2007, 2008, all the financial stocks that fell apart. I mean, there's got to be an exit strategy where you don't get involved in something where it just takes you down to zero.
My model uses stops on every holding period. Do I have time for about a 30-second story on risk?
As long as you want, actually.
I used to, when I was in front of the big wirehouses trying to sell them on technical analysis, I found out being critical of modern finance was a lot easier because they believed that for so long. But I'd put up a histogram of the annual returns of the Dow going back to 1897 or something. And you could clearly see by looking at that chart that the market on an annual basis was up about 2/3 of the time. And I say, if I was selling you an index fund or a buy and hold strategy, I'd say, look, it's up 2/3 of the time. And so I say, well, then let's play a game. I say, I promise you it's a fair game. It's $10 to play. You can play as many times as you want. And if you win, you're going to get $1 million, and there's no strings attached. That's exactly how it was. I said, how many want to play? And everybody raises their hand. And I say, and the mathematical odds of winning are 1 time out of 6. And so everybody raises their hand.
Mm-hmm.
And I say, okay, the game is Russian roulette. How many want to play now? And of course, nobody wants to play Russian roulette because the risk of playing Russian roulette is severe. Well, you should treat the risk of the market the same way. You should always understand what the risk is of every trade you put on. And the way you deal with that is have some exit strategy, whether it's a stop, a reverse, whatever you do. It doesn't matter what it is, but you have to have the discipline to follow it.
Mm-hmm. Absolutely.
Yeah, the discipline is the other key word. I mean, risk is one thing. You mentioned with your trend following model and it being rules based. I mean, in that in itself is a disciplined approach to following the market. You have rules, and I think everyone in their trading, even if it's short term trading, should have rules that
inviolable rules.
Exactly.
Yes, and you got to be very careful making rules because you want to make sure you have the ability to follow them.
I got an interesting email from someone just recently, and I won't mention any names, but they kind of scolded themselves when they sent me an email talking about Navistar, how they got into Navistar NAV, and the stock recently broke down. They've mentioned, hey, I saw it break below this level, but I kept holding it, and now I'm embarrassed to say, but I've got a pretty big loss, and I'm going to have to get out of it now. But I think part of that, I hate to say that it's a good thing, but it certainly is a lesson. I mean, I learned some of my biggest lessons in trading stocks by losing money.
Yes. No, you paid tuition.
I did. I paid a lot of tuition, especially back in the late 90s into early 2000s. That's when I stopped trading options. That was a big lesson for me.
Yeah, it's like I traded futures in the early 80s, and gosh, I was just I was just making good money. I was thinking about quitting my job and all that. And before it was all over, I ended up writing a check for about $8,000 to close the account.
Well, I know.
Enjoyed the leverage, but only on the upside.
One of the things Charles Kirkpatrick in one of his books did say is that, finding and buying a stock is really the easy part. The hard part is figuring out how to exit it.
Yes, that's very true.
Yeah.
Yeah, and I think
Charlie's got a really good book called Technical Analysis. It's kind of up there with Pring's and Murphy's.
Yep, we had him on, believe it or not.
Oh, good. Yeah, he's a great guy.
Yeah, that was a very interesting session of Market Watchers Live, having Charlie on the show. That was really eye-opening for sure. And that probably could be a one of our shows or one of our workshops going forward too, Erin, might be when to sell.
Exit strategies we use.
Yep, no doubt about it. But I do, while we have you on here, Greg, I know you're going to come out to Seattle with us, right, for ChartCon?
Yes, I am.
Are you going on the cruise as well?
You bet.
All right, that's good. I'm still looking for golf courses somewhere out in the water.
Well, they'll let you hit them off the back of a cruise ship usually, but I'm too cheap to do that unless somebody else is furnishing the balls.
Do they put yardage out into the water somewhere so you know how far you're hitting it?
No, you're just pounding balls out there, I guess.
Just for fun.
That reminds me of an old Seinfeld episode. I don't know if you're a Seinfeld fan.
I am.
I think it was Kramer was out at the beach, and he was hitting golf balls, and apparently he put it into the blowhole of a whale or something.
Oh, yes. I remember that.
You remember that?
Yes, I do. Gosh.
Oh, my gosh. But anyway, let's talk some more about ChartCon, though, because this is coming up. And we talked, you were just talking a lot about risk and being disciplined and so forth. And that really is what ChartCon this year is all about. That's our theme, is how we manage risk. And I don't know if you want to share any of your discussion that you're going to have, if you want to give anybody some little tips.
Yeah, I've been doing this for 45 years, and believe me, I've learned some things, and like you said, Tom, the lessons I learned the best are the ones where I lost money. Those tend to stick with you a little more.
Mhm.
But over the years, I was talking to Chip about what to write about or what to speak about, and I thought, I've discovered some things that I've used and seen over the decades that I think all technicians need to understand. Uh, a perfect example is what I just said about the difference between arithmetic and exponential moving averages. Most people know one hugs the data more than the others, but what they don't know is that when the price goes through an exponential, the exponential average itself actually reverses on that day.
Mm-hmm.
That you need to know that. That will help you decide what to use instead of just guessing. So I've come up with about 13 or 14 things. I called it 10 because I'll probably have to reduce it because of the time constraints. I think things like that. Some of them are a little more advanced in nature, but that's what I plan on talking about.
Well, the great thing is, Greg, is that if you don't cover all 10, those that go to the VIP and join us in person,
right,
you can actually sit down and talk to Greg about what he wasn't able to discuss during his program. And I know you're going to come on the cruise with us. And as I tell everybody, we don't hide out in our rooms or cabins. We're usually out and about. So we're happy to
sure.
sit down with you and talk about what you like. And
I really like it if they laugh at my jokes.
Yeah, I'll be sure and be the background. I'll always do that for you.
Yeah, key the laughter.
Yes, as a friend of my father's, I will take care of you.
Excellent.
You always have some funny jokes, so it's easy to laugh at them.
Oh, good.
Yes, absolutely.
Well, the nice thing about getting old, I can tell them every year, and I'm the only one that doesn't realize
it. See, that one's very funny too.
So I have to say, I mean, really, especially with the cruise, I don't know how many people have been on cruises, but that's an excellent price for two for everything that's included. Just saying. But
that's a week-long cruise too, isn't it?
Yeah, for your spouse or partner, whoever is going to join you.
Yes.
So, my daughter was very unhappy that my husband is going to be able to join me on this because I don't know if you remember last time, it was my daughter who got to go to the Napa one.
That's right.
She was really disappointed. She wasn't going to get to go on this one. So,
well, I'll be bringing Her Majesty.
Real quick before you go, because there was a question about the Zohorchak method. They were just wondering if you could speak to that a little bit as far as selling.
Yeah, it's in fact, as I do this building a rules-based trend following model, I'm going to kind of get into the Zohorchak model since the indicators are on stock charts. This is a very simple model or process, and I used to do it with a calculator and barons and red, blue, and green pencils on Sunday afternoon back in the 70s. Uses 3 moving averages and the advanced decline line. Uses the NYSE advanced decline line. Zohorchak used the Dow Industrials. I use the NASDAQ. I use the NYSE composite since I'm using the NYSE advanced decline line. And it's weekly. So you're looking at weekly advanced decline line. You're looking at weekly 5, 15, and 40-week moving averages. And then they're all put together. I've got 2-3 articles on Zohorchak. If someone goes to my blog, they can search for Zohorchak and see a detailed explanation of it. But he had no definitive selling signals other than when the moving average is rotated. And to me, that's too long. I would much rather use the Zohorchak to get into the markets, stay invested, and then keep stops on the individual holdings.
Okay.
But like I said, I plan on covering that in more detail later on. But I have 2 articles in there. Somewhere, I think I've written about 140 articles now. So they're buried in there somewhere.
Yeah. Okay. Well, I appreciate you answering the questions. And
sure.
Having you here.
Yeah, it's always great to have you on the show, and we're going to lock you in to come back and visit us often. So hope you don't mind.
No, I enjoy doing this.
I know as it gets warmer, we may have to drag you off the golf course.
Yeah, you'll call and the phone will just ring.
Yeah.
Well, if you want to pick up Greg's book, I do have it here in the Stock Charts store. But I know a lot of people were interested in the complete guide. If you do get this book, one thing you can find here is that there's the companion chart pack for it. So we don't actually have it for download, the book, but we do have the chart pack, so you can use it in conjunction with everything that he's been talking about in his book.
You know, the neat thing about the chart pack is that all the indicators that are in the book are updated every day for daily and every week for weekly. So you get to see them in real time. It's kind of that was Chip's idea. I liked it.
Yep. Yeah. And here you go. There's even a link in the stock charts store for the Kindle version of the book. So
awesome. Well, thanks again for joining us, Greg. It's always a pleasure to have you on here, my friend, and we're going to play golf soon.
Okay, I look forward to it. You guys do a great job. Keep up the good work, and thanks.
Oh, you're so nice.
All right, signing off.
All righty. So we are going to move into the 10 and 10. I don't know if you have the RRG or if you have those.
Yes,
Andy.
I do. Yeah, this is pretty much the majority of them. It looks like as far as the popular vote, everybody would like to see Boeing, I guess, again. So that will be number 2. But let's see what we have so far here on the RRG. And I know we talked about Boeing, so I don't know if you have anything more to add to what you talked about earlier. If not, we can certainly pick something else.
Yeah, I would probably skip it. And if you're interested in Boeing, you could look back into the first segment during the show. I mean, I pulled the chart up, talked about it quite a bit. So I think we grab another chart.
Yeah. This one looks very interesting. I can tell you already, allergen. So I probably will add that one. But let's go ahead and look at our first one, PayPal.
All right. I should have my screen up now. I have a daily chart here on PayPal. And the daily, in my opinion, looks better than the weekly. First of all, we did have a gap down here on very heavy volume back at the beginning of February. We made our way back. Look at that false breakout there, shooting star candle, false breakout. We came back down for a couple of days. Again, those candles don't necessarily mean that we're going to see weakness for a long period of time, but they are a short-term reversing signal. And you can see we did move down the next couple of days. But here on the daily chart, we've moved back up into this gap resistance zone. You can see the volume picking up today. But I'm going to caution you to watch this 85, 86 area, and especially if you get an intraday move up above this late January high with a failure. And the reason I'm going to caution you is I'm going to go into the 10 and 10, and I already looked at this chart and already pulled it up on a weekly basis. But check out the negative divergence here on the weekly chart. Now, negative divergence on a 60-minute chart can just play out over a couple of days. On a daily chart, maybe 1 or 2 weeks. But when you start getting these negative divergences on the weekly chart, you really want to be careful because it can get frustrating over a number of, maybe several weeks to, 3, 4, 5 months, where we can see some consolidation and very frustrating action if you're short-term, trying to short-term trade. So what I mentioned on that daily chart, if we come up here and we have a false breakout here and fail to get that breakout, or if we make a breakout and you notice that the weekly volume is really light, I'd be careful because this is a fairly nasty looking negative divergence here on the PPO, which suggests in time a 50 period test. And that 50-week moving average right now is down at 65. And PayPal's at 83. Now, I'm not saying we're just going to turn around and just shoot down to 65. Maybe what we do is just continue to sideways consolidate for a while, and we get this 50-week moving average continuing to move up. But I'm just going to throw out a warning out there on PayPal that I do see some issues here on the weekly chart. And so if on the daily chart we see false breakouts, I think you want to refer to this longer-term chart, so be careful.
All right. So, yes, next one we'll do is Allergen AGN.
Okay, AGN, it is starting to strengthen a little bit, which is good. We've had this huge move up. You can see the PPO making at least that short-term trigger line crossover. Volume trends, have me a little bit concerned. I'm going to point out a couple of key resistance levels. We're up testing that 50-day moving average now, which is potentially a problem. We got to get through, obviously. But here were the reaction highs off of this drop. So you can see very, very heavy volume, finally a little indecision. We did try to go up over these next couple of days, but we didn't get a candle body over 170. Came down, came back up again another time right here to this reaction high. So I'm just looking at this 168, 170 area somewhat suspiciously. If we can get through with some increasing volume, I think we have a shot to run to 190. But I need to see that breakout above 170. So for me, short term, I would be a seller.
Okay. Let's see, the next one in the toy space, Take-Two Interactive, TTWO.
Yeah, actually toys have looked pretty good, even though we've pulled back a little bit recently. But on and then maybe this would be a good one to pull up that relative chart on. I'm not sure on a relative basis. Here's the toy index. You can see we did just recently make a breakout, but we've been pulling back recently. But look at what Take-Two is doing on a relative basis to the toys. It actually topped 3 or 4 months ago, and I think this is beyond just a little bit of a pullback. It is now beginning to seriously underperform its peers in the toy space. And you've got also some very significant relative price support that we're approaching. So Take-Two needs to turn around and maybe take 2 or 5 points higher if it's going to begin to strengthen technically. But if you look down here at the bottom, you can see toys relative to the S&P doing very well. It's just that Take-Two isn't one of the better performers right now. So what I would do is I would be watching price support very closely, because we're already underperforming. And if we fail to hold on to, I'm going to put that low in and this low, I think we have really critical support in the lower 100s. Let's call about 102, 103. We got down as low as 106 today. I think we're probably going to head back down into this area just based on the heavier volume, on the move lower, looking at the relative strength and so forth. So this one, I think there are better choices in that toy space.
Okay, fair enough. How about Walt Disney, since we're in the toy children's area?
Yeah, Disney actually was one of my stocks that I thought would do pretty well this year, but you can see it fell apart in February. This doesn't have the, I'm going to go back over to the daily chart, because I think on these highs, yeah, you can see at the very top, see the negative divergence on the PPO. You got higher prices. Let me annotate this, make sure everybody sees it. But you have the higher price clearly moving up, and there, I think it's pretty clear. You can see that the PPO is lower. So that's just telling you that it's running out of price momentum to the upside. Notice, as long as we keep putting in these higher PPOs, the pullbacks hold that rising 20. But as soon as we get this negative divergence, double top in, that's when things fall apart here to the downside. I would be watching the 100 level on Disney. I think this is an important area. And that goes all the way back here to this breakout in November, because that's when all of this started, where the PPO broke to the positive side, pulled back, held the 20. You can see all the weakness we saw in February held this level. So I'm thinking right now we're sideways consolidating between 100 and 113 on Disney. The closer it gets to 100, I actually like Disney. I think it will outperform as it gets closer to the 100 level. As it gets closer to 113, though, we've seen multiple tops here. I would take my money and run. Any move to the downside here, you can already see that the PPO has started to rise. So I think it's likely running out of sellers. And as we get closer to the 100 level, if we get closer to the 100 level, I think the reward to risk really turns in the favor of the longs.
All right. Let's see. The next one, PetMeds, PETS.
All right, pets. We've been talking about this. Needs to get through 48. I think that would be a very bullish development in the chart. This was the high after earnings. You can see the heavy volume. Now, there was a lot of selling, but I think a lot of good news was built into the price, and we got the earnings, and then there was a sell-off. So buy on rumors, sell on news. We saw this earlier back in October, where it started to make a move up, gapped up hugely with earnings, pulled back, and then started resuming its uptrend. I think we could be doing the same thing here, but clearly we need to break above 48. That is where we keep getting stymied. Close above 48 with an increase in volume, and I would be a buyer.
All right, excellent. The next one, Apache APA.
All right, Apache. Well, I mean, first of all, it's in the space I don't like. I know that we had Greg Schnell on recently, and he was talking about some of the fundamental issues, or not issues, fundamental strengths of Apache, but the price is just not showing it yet. I need to see this in technical form in breakouts. I mean, you could see we had a pretty good support level there that was broken to the downside. On the reaction move, the upside couldn't get through. Another huge volume selling episode. And now we're coming up and testing the 20-day for the first time off of this downtrend. So to me, I think that we got some issues here. And my guess is we're going to really struggle between that level And then the latest price breakdown on that heavy volume right there, taking out all this sideways consolidation. So I think 36, what's that 20-day at? 36.36 up to $37. I think that is a pretty significant resistance area. I'd be a seller.
Okay. Let's see. The next one, Adobe was a popular.
All right, I just want to say Adobe reports, and I think they report tomorrow after the bell. So you do have earnings coming up. Outside of that, I love the stock. I mean, I think it's in a great space. This is another one I think would be great to show the relative chart. Now, here is Adobe rising. Here's software rising. Here's Adobe rising relative to software. Here is Adobe rising relative to the S&P, and here's software rising relative to the S&P. These are the kinds of stocks you want to own. So Adobe, I think, is a great candidate. The problem I have is it has been moving up. I think you're going to see great earnings, but the question is, are the great earnings already built in? I would be watching two key areas to the downside on Adobe. This was the breakout above the November high. We went back, successfully tested that. Here was the next breakout, and we have successfully tested that. So I'm going to say 202-ish is a really good support area. A lot of good news anticipated. So if Adobe comes out with good news and we get a sell-off, sell on the news kind of a thing, I think the 202 area would be really interesting on the long side. Something to watch for.
All right. Let's see. Let's try Goldman Sachs in the financial space. Does look like a rising wedge. I think that's what somebody had mentioned.
Goldman Sachs. Yeah, a little bit of a struggle here. Actually, I'm going to get out of this relative. I want to see a little bit more data here. Yeah, I'm actually looking for it to hold on this rising 20-day moving average. I started to see a little bit more strength. I think part of the problem here right now with Goldman Sachs is that the 10-year Treasury yield's been dropping, and it's back down close to that 280 level. Maybe we get a little bit more of a push to the downside. So I'm going to say that there are two areas that I like Goldman Sachs on. And I like it going forward because I believe interest rates are going to go higher. And right there is the 20-day. If we do see the 10-year Treasury yield break down and financials start to give away a little bit more, I could see another retest of 255. But I think this is a zone for me that I would actually be accumulating. I like Goldman Sachs.
All right. Next one, Caterpillar. Looks like a symmetrical triangle here. Not doing much. I don't like the PMO at all. It's turned down below its signal line. So,
yeah, I think we're probably going to continue to just work our way in this triangle. So I think you've got some pretty good support coming in at the recent lows. Let's just say around 145. This is one that we talked about maybe a week and a half ago when we put in this bullish engulfing candle off the downtrend. We did see a move to the upside, but then we got a bearish engulfing right at the 50-day and starting to move a little bit lower here. What I would continue to watch is the lower highs that continue to print. And so I think if we get a breakout above 160, I think that is going to clear the trend line and then also the 50-day moving average. That's what I would be looking for as a technical catalyst to carry Caterpillar higher.
all right. And our final one is IPG Photonics, which is IPGP. And I do see an ascending triangle here. That's what the requester mentioned. And I have a new PMO buy signal in oversold territory. So I'm thinking a breakout here could be pretty interesting.
Yep, I like it. I like the higher highs and higher lows. Here's a high, low, higher low, continuing to work our way up. Volume trends, I'm not quite sure what happened here because it really didn't have a huge day price-wise, but volume, obviously, something happened. I mean, we definitely have a trend line here. I wouldn't, for me, I'm a pretty, I got to see, almost a book type pattern. The problem is this: if you start here with these lows, this isn't the top of the move. This is the top over here. So this is where technically it would start. So we do have one move down, but we haven't tested yet this high. I mean, it certainly could evolve into an ascending triangle, but we do need some equal highs almost up there. I mean, for some, maybe you want to call that equal highs. I'd like to actually see a test of this recent high and then maybe one more pullback. But I agree. I think the longer term chart here looks good. And I expect ultimately a breakout above 265. Just make sure you get some volume with that move to the upside.
Awesome. And that concludes our 10 and 10. 2, 1. And you should be able to see right now the symbols we went over. I will have these up and in the Market Watchers Live chart list. So you can go to the Market Watchers Live blog page. And at the top is the link to go to our chart list. So you'll find all of those 10 and 10 symbols in there annotated. So go check that out if you want to see them again or save them to your own account. That's also, everybody is asking you about how to set up relative charts. I know that at least 1 or 2 in the 10 and 10 you usually save as a relative chart. Am I right?
Yeah, normally I have the relative charts, and I think I've shown in prior shows. Maybe when I get the screen back later in the show, I'll try to remember. Maybe you can remind me, and I'll go down to the bottom and just show you how you can set that up. But I think that's a great way to get a lot of information, not only about the stock, but also about the group that it's in and how it's performing relative to the S&P. Because after all, hopefully that's what we're trying to do, is we're trying to beat the S&P 500.
Absolutely. So yeah, if you see a relative chart you like in his blog, just click on it. Or if you're in the Market Watchers Live chart list, click on it, get it to your workbench live, and then you can just save the chart style. And then you have it forever. And you can put it to any stock and it'll set up those relative ratios for you. So with that, I'm going to move on to our market summary here, market update. Give me a second. Let's see here. Keeps going there. I have to get rid of that. Okay, so I am going to just take us to our member page. We're going to go look at the candle glance to see what's been going on. I will add the TSX right here. And we will put TLT in here just for grins. That's my daughter will say sometimes. All right, here we go. So as you can see, the last 2 days have not been particularly good for the Dow, and we're continuing that that declining trend right now. Looks like we may have set an intraday low, may be able to bounce off of that low, and you can see similar lows on the S&P 500 and the NASDAQ as well. NASDAQ not having quite as bad a day as the Dow and the S&P. We can see Russell 2000 also down on the day, but it's starting to, it had been bouncing. It looks like it's going to head back down though. Not liking that too much. TSX still trading volatilely, as you can see, but currently down. We have Treasury yields lower today, currently reading 2.813. We have UUP almost unchanged. Look at this double top, almost textbook. And if you measure that, it would take you almost exactly towards yesterday's close. So I think that's always an interesting instruction to see these chart patterns can be applied to these shorter term charts. So currently UUP is up slightly. We can see the commodities are mostly unchanged right now, volatile trading today. USO is unchanged currently. GLD, gold, gap down, has been really moving mostly sideways and consolidating today, down only 16 cents for GLD, 125.62. The VIX is rising, but we're still looking at a reading of only 17.25. That's not too bad as far as nervousness goes, but we are starting to see it trend higher. TLT, really benefiting from the yields moving lower. We have a nice move up, has hit its intraday high and is pulling back somewhat. We'll have to see if it can hold on to the 120 level for TLT. Quickly go to the market summary, see how our sectors are doing. And I'll do this by percent change. And as we can see, utilities and consumer utilities is the only ETF spider that is currently rising right now and is up 20 cents. And we can see consumer discretionary technology are followed by that by utilities, but they're in the negative. So the worst performer right now is the materials ETF XLB. And as far as our industries go, oil services, disk drives, utilities, not a surprise, all at the top. And those getting hit the hardest, airlines, which I know was leading the list, I believe, yesterday. It is now down, the XAL is down almost, well, a little over 1.5%. Sweden is leading as far as our international ETFs are concerned, really performing far better than the majority of the foreign ETFs that we have. And we can see internationally, Belgium and Russia are the laggards, with Belgium down 0.9% right now currently. And with that, that completes our market update. And Tom, did you have anything you wanted to add?
No, I think we're good. I was watching the NASDAQ and I saw that NASDAQ did move up back to the flat line and then has turned back over. I think that's probably the one interesting thing I'm going to watch into today's close, because we are seeing leadership from the NASDAQ. And as I mentioned on that hourly chart, I do think that the test of that gap support zone on the hourly chart is pretty interesting. So we'll see whether or not that holds. I still am not looking for a lot more weakness on the NASDAQ, even if it doesn't hold, maybe another 1% or so. But I'm continuing to look for leadership from NASDAQ stocks.
Yeah, it's right now, I think when I look at that daily chart, pretty important support here at that January top. So my only concern, and somebody I think did mention it, might have a rising wedge. And, you know, typically you look for a breakdown from that. But with this steep rising bottoms line, you know, I think even you could get the breakdown, it wouldn't have to fall too far. So, but, you know, the PMO is still looking good. So I would expect further strength as well. But I do want to see it hold that level.
Mm-hmm.
Scooters.
Scooter, time for some scooters. Are you ready?
I'm going to pass it to you. I want to get some charts together.
Okay. Let me take a look here. All right. I think I'm ready to go. Let's take a look. And I tell you what, first thing I want to do is just kind of show you where you can find the scooter reports, and then what you can do with some of the knowledge of what areas of the market are performing well. So I mentioned earlier that semiconductors are doing really well, and also software. And I am of the belief, I'm going to come back to this members dashboard in just a second, but I'm of the belief that we are starting to move higher in the dollar, which should help small caps. Now, I could be wrong. We haven't gotten any confirmation of that yet. The thing that makes me believe it's going to rally is what I've talked about in the past, where the 10-year Treasury yield here in the U.S. is moving up more rapidly than what we're seeing around the world. And that normally means a strengthening dollar. Last two times we had those negative divergences where the dollar actually went in the opposite direction, the dollar came roaring back. So that's why I'm looking at establishing or potentially establishing some positions in small caps. So having said all that, and using the dollar kind of as that background reason for considering some of this, you can go down under the reports and analysis tools here to scooter reports. And it is broken down by large cap. So you can look at large cap if you want. But again, if the dollar rises, there will be a headwind for large cap stocks, multinationals. Then you could go into mid caps. I'm gonna stick with the small caps here. And what you can do in this table is just type in your industry group. I mean, we could sort it and then move to the page. But one thing you can do is just type in semiconductors. And you will see all of the small cap semiconductors come up, and they are in scooter order, which I think is pretty cool. So taking a look at a couple of these, Cree, and you're going to see when you pull them up that these are really nice looking charts. Sideways consolidation here for about 4 months. Look at the volume pickup and the breakout on Cree. I think that this stock continues to look really strong. We got a flag pattern in play. Maybe we pull back one more time to 41 and catch that rising 20-day moving average, but I think Cree looks very interesting. Now, I could keep going back to this list, but what I'm going to do is just kind of go right down, pick a couple of these high ones. Cabot Microelectronics. You can see a triple top coming across. We made the breakout, increasing volume. The overall volume on this one's a little lighter than what I would like to see, so really it's up to each individual whether or not you would want to trade this stock. But it is also a $115 stock, even though it's small cap. The price of the stock is pretty high, so when you multiply that times the number of shares, still quite a bit of dollar volume in the CCMP. But anyway, that one is an interesting candidate. MKSI breakout recently. Check out here when we got this breakout of all above all this consolidation. Make the breakout. The PPO turns up. Notice where we hold on the pullback. Rising 20-day moving average. We now break out to new highs. PPO looks good. If we get weakness down to the 20-day, that's something I would consider. Another stock, MPWR. I'm skipping through some of them because I looked at these charts already. MPWR, look at that false breakout right there above these prior highs. That, with that bearish engulfing candle, tells me we might get a 20-day test. The PPO looks good. So I'm looking for maybe a 20-day test and then a push back up and a breakout on MPWR. AMKR, this is Amcor. Another one that got right up to resistance, printed this bearish engulfing, pulling back, but has a strong PPO. A little bit more selling down to that rising 20-day moving average. I think that's interesting. Now let's go back to that scooter report one last time. And this time what I'm going to do is move to the small caps. And let's pull up software, which is a very strong area of the market. And one of the stocks I talked about recently, this is on my strong earnings chart list, NTNX. This thing has just been on fire. Got to have some kind of a pullback before getting in. But look at the volume coming in on this stock on the move to the upside. So when you get these stocks with high scooter ranks, that's already telling you that you've got a pretty strong stock technically. And then it's just a matter of finding stocks that you like in terms of industries and price. I'm not just going to get in at any price. I'm going to maybe put it on a list and keep an eye on it, but I want to see a pullback. I want to get in on some weakness I don't want to chase. IMMR, another software stock. Look at the beautiful move up. Huge gap up here with very heavy volume, followed up with another one the next month. Stock continues to trend higher. And again, we could go through a bunch of these. I'm going to go down closer to... let's see. Well, I know TWOU, 2U Inc. is on my strong earnings chart list. And actually, yesterday we had a 20-day. Look how quickly, if you got this on your list, it comes back down. You got a strong PPO at the high, comes down, hits the 20-day or right at the 20-day. The very next day, it's up $5 off of that. That's like a 6% move in a day if you happen to catch it. Unfortunately, yours truly did not catch that one.
It happens. Come on now.
Well, it probably happened while I was preparing for the show or doing the show. It does have an impact on my trading, no doubt. But yeah, that's some of the things that I would look for. Maybe one more. Let's go down here around 70. Let's see if we can find one. Oh, TTD, this is on my list. This is on the strong earnings chart list. And here was the gap up with the heavy volume with earnings. Now, this one clearly isn't as strong as some of the others. It's been going sideways, but I love that gap up with heavy volume. Came into gap support, and now you can see it's struggling right at 60. But again, anything back down around 54, 55 would be pretty interesting at this point because now we've established some support. But anyway, with that, I am going to turn it over to you, Erin. What do you have for a scooter?
Yeah, I'm just going to show, since we don't have a huge amount of time, I want to just show people how to use the scooters and get to them. I do know that somebody had a question too about setting up different time frames. So one of the things that you can also do is, rather than go into scooter reports, I mean, we have so many different ways to get to so many different things. So you can go in here and look at your S&P sectors. If you want to do it for a longer term time frame, let's say a 6-month look, now you can see what we're looking at here. You can do the scooter ranking as well. So at this point, you know, technicals and cyclicals are leading. Financials, if we're thinking the yields might start, the interest rates might be moving higher. Financials we know might do well. So I'm just going to look into the financial area. Again, you can't do industry groups with a scooter. They just aren't there. But what you can do is look at, okay, well, which ones have done really well over the past 6 months? Okay, well, investment services looks interesting. Just click on it, and now I have all of the investment services stocks over the last 6 months is what I'm learning about what the change has been, percent change wise. And then also you can go by, you know, what group it's in. I would recommend going first by your scooter, and then maybe going by the capitalization here, whether you want the small, mid, or large cap. So I just really wanted to show everybody how you can use the scooter, get to the scooter. And if you want to learn more about the scooter, just go into the chart school and do a search on stock charts for scooter, and that is the stock charts technical rank, and then you can read more about how we come up with it. But it's a great determining factor to give you more of a intermediate to long-term look. It, in my opinion, gives you the look at what the relative strength is, as well as internal strength. How it's rating. That if it has a high scooter, it's internally strong, because these are the this is the formula that goes into calculating the scooter. So I thought I would just show that for our scooter report to begin with. I think you covered quite a few good stocks. So here you go. How you get to the summaries and time frames can be changed. And then there are the list of symbols that you covered, Tom.
Yeah.
So yeah, go ahead.
I was just going to say, with the scooter, one thing you have to understand is when you went through that calculation of the formula, a lot of the weighting is based on long-term indicators. Mm-hmm. So the stocks that get a really high scooter rank and stay there are stocks that have been performing well for a long period of time. If you go back and you look at something like NVIDIA, when it first started its uptrend, and the scooter rank shot up to 99.9 or whatever, initially, when it would have pullbacks, you would see the scooter drop. But over time, as it continued trending higher and higher, that scooter rank was not nearly as sensitive to some of the short-term pullbacks. And that's why you see NVIDIA over, say, the last year or two staying up in the upper 90s, even though you do see pullbacks from time to time. That's just the way the math works. And, you get back to what Greg Morris was talking about earlier. You need to understand what these weightings do. I mean, they're not some magic formula that, oh my gosh, the scooter's 96, that means it's going to go higher. It's just an indication. It's a tool that you can have, that you can use here at Stock Charts, an exclusive tool only to Stock Charts members and users, that I think can certainly point you in the right direction for a lot of great trades. But it is not by itself the only thing you need to consider. Just make sure you understand. And as Erin mentioned, probably be a good thing to check it out in Chart School.
All right. And you can see we're still taking the poll as to what my workshop should be on Friday. If you just go to the polls tab in Slido, the chat window to the right of the viewer. And if you are watching the recording, this poll will still be open through, I believe we're going to keep it open until tomorrow morning. So feel free to go in there and get your vote in. Interestingly, I mean, we have a split, but I don't know if it's too close to call right now. It looks like we're definitely leaning toward volume indicators and definitions and analysis. So I'll touch on that if that turns out to be the subject. Intermediate and long-term investing. I was going to look at my strategy, how I go through and use the stops and what indicators I use when I'm looking at intermediate to long-term investing. And then the moving averages, definitions, and analysis. I think Greg Morris touched on this briefly, and I think it's very important as well to understand the different types of moving averages and what data you're seeing based on that. So anyway, hopefully you're seeing this poll, and at this point we're doing pretty good. And we have about 258 votes so far. Not bad. 270. Look at that. So go ahead and take those votes, and we'll see which one I will be doing. And I'll save the other two for the next time as far as choices.
Yeah, it looks like with about 90% of the precincts reporting, it looks like you're going to be doing volume indicators, but it's not official yet.
No, it's not. No,
not official. Yeah, I'm so anal when it comes to numbers and stuff. I was looking. I just saw the added the percentages up a minute ago. It was 45, 35, and 21. And so, of course, that's 101%. So,
well, I'm not sure how that works, but
I can't help it. Yeah, I'm not sure how that works either. But we do have some things coming up. So why don't you go over that with us before we wrap up?
Yeah, absolutely. So as far as the weekly schedule, tomorrow we have Julius de Kempenaar here, the creator of RRG and staff writer here at Stock Charts. And then we also will be doing my workshop on Friday. Obviously, the subject to be announced tomorrow morning. So get your votes in, and help me out a little as to what I need to start preparing for.
Yep. And I would just say, as we wrap up today, continue to watch some certain levels on the overall market. I do find it comforting that the NASDAQ continues to outperform. You know, if everyone's getting really nervous and you start seeing money rotate away from the aggressive areas of the market, we should see the NASDAQ actually declining further than the Dow and the S&P, but that's not the case. In fact, right now, one final note, NASDAQ down 6 points back at 75.04. So it is trying to hold on to that support level that it had cleared, the resistance that it had cleared from back in January at 75.06. I think if we close over 75.06, that would be somewhat bullish.
Absolutely. I agree.
Great. And with that, I do want to thank everybody for stopping by today. Special thanks to Greg Morris for stopping by. We always enjoy having Greg on the show. Please remember to complete the survey as you exit. We'd like to get your feedback, hear what you think of Market Watchers Live, what you think of, or what you thought of Greg's presentation, which I thought was awesome. And as a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays, from noon to 1:30 p.m. Eastern Standard Time. Have a great afternoon, everyone. We'll be back here on Thursday. Take care and happy trading.